This Friday, Nebius fell 15% in a single day. $33 off the share price. I own this stock, so that one stung. 3 days before that, Nvidia told regulators it had quietly bought 9% of the same company. So one of the most important companies in the world is buying in, while the market is selling out. Today, I will explain what's actually going on here, because the reason for the drop matters more than the drop. Quick disclosure, I do hold a bit of Nebius, so I am not a neutral here, and you should listen to everything I say with that in mind. Here is why this one matters even if you never buy a share. Nebius is what people called a NeoCloud. Basically, they buy tens of thousands of Nvidia chips, wire them into data centers, and rent that computing power to companies building AI. Companies like Meta and Microsoft are their customers. NeoClouds are amongst the picks and shovels of the AI boom. And Nebius has become the cleanest test I know of a question every investor is asking right now. How do you tell a genuine AI winner from an expensive story? This one looks like both at the same time. Let's start with the chart because the range tells you what kind of stock this is. Over the past year, Nebius traded as low as $50 and as high as $299. It closed yesterday at $187. Same company, same 12 months. Now the backstory, which still surprises people. Nebius used to be Yandex. Yes, that Yandex, the search engine people called the Google of Russia. After the war in Ukraine, the company sold its Russian business, kept the international pieces, renamed itself and relisted on the Nasdaq in late 2024. And the founder, Arkady Volozh, still runs it. So this isn't a startup that appeared last spring. It's a 20-year-old engineering team pointed entirely at AI infrastructure. There are a few smaller businesses attached too. A data labeling arm, a coding school, a self-driving unit. Some people even call it a mini AI ETF in a single stock. The growth that Nebius has shown is the reason that makes people lose their minds, and honestly, it's hard to argue with. Last quarter, Nebius did $390 million of revenue. The same quarter a year earlier, it did just $51 million. That's up more than 600%. The number management cares about the most is ARR, or annualized run rate revenue. Take what you're earning quarterly or monthly right now and project it over a full year. The last quarter, Nebius reported that its projected ARR is around $8 billion. Analysts expect revenue to keep compounding around 47% a year. Then look at who's signing the checks. In March, Meta signed a $27 billion 5-year deal. $12 billion of committed capacity, another $15 billion optional. Microsoft signed one worth up to $17 billion. And everything up, and Nebius says it has over $40 billion of contracted revenue from investment-grade customers. And on 21st of July, Nvidia disclosed a 9.3% stake. The most important chip company on earth is now a shareholder in this thing. That is a genuinely strong bull case. Real customers, real contracts, real backing. So, why is the stock down more than a third from its all-time highs? Two reasons. One is a number almost nobody mentions. The other is a headline from the 1st of July that changes the whole sector. You'll see people posting that Nebius is now profitable. Technically true, practically very misleading. Last quarter, it reported roughly $621 million of net income. But about $800 million of that came from writing up the value of investments it holds. That's an accounting gain on paper. Strip it out and the actual business of renting AI compute lost around $128 million running day to day. Look at the risk box on the screen. simplywall.st flags it plainly. High level of non-cash earnings, 97% accrual ratio. In English, almost none of that profit arrived as cash. The second problem, and this is the one I actually worry about. The business eats money. Management guided to $25 billion of capital spending this year, against only about $9 billion of cash on the balance sheet. You don't need a spreadsheet to see the gap. So they're funding it in two ways. Debt, like the $775 million facility they raised on the 17th of July, and issuing new shares. The total share count is up roughly 30% in a year. When a company prints shares, your shares quietly lose value. And then there is the price. Every valuation check on this page is red. 0 out of 6. After Friday's fall, it trades nearly 59 times earnings. And remember, those earnings are mostly non-cash. It was over 70 times a week ago. So the drop has made it cheaper, not cheap. And insiders have sold about $29 million of stock in the last 3 months, including the chairman in mid-July. None of that makes Nebius a bad company. It makes it an expensive, cash-hungry company in a hot sector, and those two things can be true at once. Now, the thing that actually broke the sector, and I want to be honest that I didn't see it coming when I bought in. On the 1st of July, Bloomberg reported that Meta is building its own cloud business. They're calling it Meta Compute. The idea is that Meta rents out its spare AI computing power to outside developers by the hour, which is almost word for word what Nebius does. Read that again with the $27 billion deal in mind. Nebius' biggest customer is now planning to sell the same thing Nebius sells. The market did the maths instantly. Nebius and CoreWeave both fell around 15% that day. Since then, the whole NeoCloud group has been derated, and Nebius is down roughly a third from its June high. So how worried should we be? Here is the fair version of both sides. The bear case is simple. If your anchor customer can supply itself, your contracts are a ceiling and not a floor. And renting out GPU starts looking like a commodity business with a very expensive shopping list. The bull case is that compute is still supply constrained. Meta has been short of capacity all year, and Zuckerberg himself said in June they'd only do this with genuinely spare capacity. Having contracted rights to more compute is still an advantage for Nebius. I don't think anyone honestly knows yet which one is right as of now. What I do know is that it moved from a risk nobody discussed to be the single most important question on this stock. So what do I think? I won't call it a safe compounder, and I won't call it a bubble. Nebius is a discovery ticket. High risk, high potential, size small, watch closely. My thesis is 4 specific things now, and the 4th one is new since the Meta news. 1. Their ARR keeps climbing fast. 2. They fund the build-out without endlessly issuing new stock. 3. Microsoft deployment stays on schedule. 4. Meta keeps taking the capacity it contracted for. That 4th one is the whole ballgame. If Meta quietly walks back on that deal, I'm wrong, and the price today won't be cheap at all. However, if they take the capacity and this sell-off was just a market panic and possibly a good buying opportunity. And one thing worth knowing before anyone does anything. They report earnings in a few days on the 6th of August. A company like this can move 20% either way on reporting earnings. So what am I doing with my own money? I own some of it. On Friday, down 15%. I did nothing. I didn't add and I didn't sell. That's not indecision, it's a rule. I don't average down into an open question. And Meta Compute is a very open question. Buying more here would mean betting that a headline I can't verify yet turns out to be noise. So I'm waiting for 2 things before adding more. Management addressing the Meta relationship directly on the next call, and 1 clean quarter where cash starts following those contracts. So what would actually make me sell? If they fund the expansion with more dilution, or if Meta's commitment visibly softens. If you want to see more of such no-hype breakdowns, like the video and subscribe. I'll cover Nebius over the next few days, including the bear case that could actually break it.